We want to understand this new NHIF rates. What do they mean? What do they mean for employees? What do they mean for employers? Many of you are employers, all right, and you pay your staff salaries. So as you pay salaries, from the end of this month, the employer is also expected to contribute more for each staff. How much more? And what are the scales? And why? And what does that mean for you? For you as an employee, you also contribute more towards your own retirement benefit through NSSF. What does that mean? How much? Why did it begin now? When did this conversation begin? Are we just finding out now about a conversation that's been taking place for a while? Davis Ongiro is joining us for that conversation. Davis is a financial services expert. We want to welcome him with the day's proverb from Zambia.
Yes, this actually is our final proverb from the country of Zambia. Bam, if you do not have teeth, do not break the clay cooking pot.
If you do not have teeth, do not break the clay cooking pot.
Yes.
Keyword here, clay cooking pot.
Yes, a specific pot that is used specifically for cooking. Yes.
And once you break in the clay cooking pot, it means
whatever food
chances
was
of
supposed to be cooked in
of
that
mending.
pot, yes, there'll now be issues.
Yeah. Davis Ongiro, good morning.
Good morning, Eric.
Thank you very much for joining us. Welcome to Kenya's biggest conversation.
Thank you so much for having me, and good morning once again.
This proverb is from Zambia. When you hear it, does it ring a bell? Do you relate?
It does, because I think once Charles was speaking, I remember the last time I was in Lusaka, so I'm very quickly relating. But we are talking about also how to deal with the problems today and how you are tying them to the future. You have to find a way that whatever you are doing, and including the discussion we're having today, that you do not, everything has to be tied. So if you break your pot today, what are you going to use tomorrow? You must be able to create a balance always on whatever you are doing, especially tying that to the future.
Your actions today
Matter a lot.
may matter a lot for tomorrow. Okay. You're being deducted today because it should matter a lot for your tomorrow in retirement. Let's have this conversation about NSSF rates. So first of all, just to clear the air, what is this story about the NSSF rates from end of this month and all?
Eric, you know what happened, or what is currently happening before this February is you have been contributing 200 shillings every month to NSSF. The employer also matches that exact amount.
Yes.
If you calculate that is 400 shillings per month, multiply by 12 months, that is 4,800 shillings. Even if you saved for 20 or 10, 20 years, that is around 4,800 times 10 years is 48,000. 20 years is 96,000. If you go for 30 years, it's somewhere around 130, 140. Even if you saved, including income that is earned by NSSF, by the time you retire, if you worked for 30 years, you will never have more than 200,000 shillings. What that means, we are having a problem of people retiring, having worked for a very long time, but when you get to retirement, you become a beggar. Because you remember, children are not a retirement plan anymore. You must be able to be sufficiently prepared enough so that when you get to retirement, you are the one. I think we are used to having parents sending parents to our money every other time. My mom calls, you need my chama, I have not paid money and all that. We need to get to a point where our retirees, when they get to retirement, they have sufficient income. They are the ones calling you, asking you, hi, Eric, are you okay in town? Have you paid your rent? Can I send you some 30,000? Instead of it being on the reverse. So the industry tried to think, how do we improve on this something called income replacement ratio? So that when you retire, Eric, it is expected by research, and this was a research done by the stakeholders and the Retirement Benefits Authority a few years ago, you need to ensure that you replace at least 75% of your income. So if you're earning 100,000 Kenyan shillings, you need at least 75,000 for you to live fairly comfortable in retirement. If you can be able to go to 80, 85, the better for you. But most of us currently, where we are at 40%. So that means if you are earning 100,000, you end up with 40,000 Kenyan shillings.
David, good morning.
Good morning.
Now, if I got you right, 100, let's say 100,000 shillings you're earning. What I hear you saying is that in order for you to live in retirement, you need 75% of that on a monthly basis, the way you were earning 100,000. So what you're saying is have 75,000 for your months of retirement for the rest of your life. Okay.
To maintain that lifestyle.
To maintain that type of lifestyle, correct? Yeah.
So that you don't have this situation whereby you're now calling
Becoming
Davis
a
in the
burden.
city. You called it a beggar. Okay, now how is this supposed to happen?
So how it's supposed to happen, one is that you need to start saving enough now. So that is what the government was trying to do. They are looking at 200 shillings per month is not really able to get you sufficient income when you get to retirement. So what they are trying to do is how do we increase that type of contribution rate so that by the time you get to retirement, somebody fairly can be able to afford a monthly pension that is a bit sufficient. So that is why the discussion on the increasing of contribution rates to 6% began from. I think this is a discussion that began in early 2000, but the act came to enactment in 2013, and thereafter it's been here and back in terms of court. One major issue has been that our constitution provides for public participation. That was not, I think, done, arguably. But the Court of Appeal came and said, no, the lower court did not have jurisdiction even to hear this case in the first case. So it should be able to proceed to where it should proceed. So if you ask me, it is a good thing that we're having this discussion in increasing the rate of on the amount that we are contributing per month.
Okay.
And we need to go back and tell our people that we need to, it's for retirement.
Yes.
I have seen when you go to the village, I come from a village where you go find old wazes, those who are 70 years and above, the social protection, I think they must be given 2,000 shillings per month. You find very frail wazes lining up in
They're
a
waiting
bank,
for that money.
waiting for 2,000 shillings. If I gave you, Eric, 2,000 shillings, you cannot be able to meet your needs here in Nairobi for a single day. But that is the amount of money that is being given to our old people there.
Can I go back to this calculation that you did?
Yes.
Before you, so you told we ended up with this 400 shillings per month. We ended up at this retirement, let's say after 20 years, what you would have accumulated comes to about 200,000 shillings. So essentially, we are saying with this 2,000 now, that right?
Yes.
2,000 and then matched by your employer, another 2,000, 4,000 shillings per month. That will come to
A factor of 10.
factor of 10 exactly.
Yes.
So now you're looking at
2 million.
2 million shillings. Is that adequate now, in your opinion, to now be able to sort out these years of
You know the Eric, when you do the actuarial
this is Eric. I'm Ndu.
Yeah. When you do what we call actuarial computations in terms of income replacement that are 2 million Kenyan shillings can be able to purchase for you, it will give you about 20,000 Kenyan shillings per month. For a retiree, 20,000 shillings per month is a lot of money. Especially assuming that all other factors kept constant. You do not have children who are going
depending on you.
to grade 1 when you are age 65, when you have a medical cover so that you do not have to be fundraising every other time. That 20,000 is a lot of money for a retiree. Most of them even relocate to go work from the village. So when you give them 20,000, 2 million can be able to give you 20,000 Kenyan shillings. What the law has done, the Act of 2013, it has come and said that the first year you will contribute 1080 shillings as an employee, 1080 as an employer. That they are basing on what we call lower earning limit. The lower earning limit in 2013 was 6,000 Kenyan shillings for the lowest earning category of people. 6,000
Who are
shillings.
employed in which sector?
In on average, whether it is your house girl, your shamba boy, the lowest cadre used to be paid 6,000. I think that has
In the urban or in the rural areas?
Well, they have given different rates for urban. For Mombasa, a certain rate. For Kisumu, a certain rate. For different areas, a different rate. But what they have said, because of for purpose of uniformity, the lower earning limit standard that will be used is 6,000 shillings. And then the upper earning limit is 18,000 shillings. So even if you are earning 1 million, your pensionable salary as per the NSSF Act will be based on the lower earning limit and the upper earning limit. For the first year, the upper earning limit is 18,000 shillings. So as we go, the upper earning limit keeps changing and the lower earning limit keeps changing by increasing. So as we get to the 5th year, the upper earning limit will be based on 4 times the national average salary. So in 2013, the national average was 36,000. Currently, I think must be around 45,000. So whatever you'll be contributing the 5th year will be a factor of that 4 times the national average. So it will get to a point where we are really contributing a lot of money.
So it will not be 2,000 at the fixed.
No. It will keep increasing every year. It will keep increasing.
Okay.
Like now you are doing 1440. That is what we call tier 1. Tier 1 is 360. Tier 2 is 720. You add 360 plus 720. That is what is forms 1080. And then now in year 2, that 360 will move to 420. And the other one will move about to 1740. So we continue that way. Now the discussion keeps changing. Now we move from a point where we are at 0% to somewhere around a good number in terms of those people who are accessing better life in retirement.
This whole thing is only looking at one pot where you're saving for your retirement, and this is the NSSF. But the law allows for you to have other pots where you're saving for retirement. Why is it not looking at all of them and saying, as long as your full pension deductible is X, you're fine? Why only factor in this state one, NSSF, and not the other pension schemes?
In fact, Eric, what has happened, the Act actually provides for these other schemes.
Yes.
So tier 1, you must always take it to NSSF.
Okay.
You must always take it to NSSF. Tier 2, you have been told you can either take it to NSSF or take it to a private pension scheme. Most people will prefer to take the tier 1, which is the minimum, to NSSF. Tier 2, they take to a private pension scheme where they know maybe there are better competitive returns, good governance, and the element of accessibility and technological advancement and all that, and convenience, compared to the challenges that might befall on NSSF. Historically, we could get a few challenges here and there, but they have provided. So you'll find, Eric, when you take money to a private pension scheme, the return is about on average 10%. You need to get to a point where when making the decision whether you are tier 2, you should take it to a private pension scheme or to an NSSF, you ask yourself, what is the return on investment? If I want to retire, how soon does NSSF process my retirement? How soon does that money hit my account? And all that. So there are so many good things that have been done. So one thing that we are lucky is that the tier 2 is not a must to take it to NSSF. The other good thing that I like about this discussion is that what they are saying, if you contribute, the normal retirement age is 50. No, the early retirement is 50. The normal retirement age is 60. If you contribute less than 36 months, when you are getting to retirement, they will pay you the total of tier 1 contributions and tier 2 contributions plus the income accrued. But if you contributed for more than 36 months, then the law requires that they must give you a monthly pension for as long as you are alive. So if you look at it also, you might only manage to do maybe savings for, let's say, like 5 years or 6 years, but it helps a way to ensure that at least we address the issue of also a monthly income.
And that monthly income will not be dependent on the number of years you contributed.
Yes, and the amount you have already contributed.
And the amount you've contributed.
Yes.
It will be a fixed income.
Yes.
Regardless of how much you contributed.
So what happens is when you get to retirement, they will calculate how much total you have. The current NSSF fund is a provident fund. What that means is when you get to retirement, you will be paid the full lump sum. And then the new fund will be a pension scheme. Pension scheme means when you get to retirement, you are only paid a third as lump sum. 2/3 you must purchase a monthly pension, which is called, you can go either for an annuity or an income drawdown. So most of us, actually the thing is, you must go to the insurance company, pick an insurance company that gives you a quote, go to NSSF and tell them that I've picked on this insurance company, now send the money, so I start receiving a monthly income from there. So it has addressed, so people is not forced to ensure that they take the full amount. In fact, when you calculate tier 1 and tier 2, tier 1 is the lowest.
What is tier 1 and tier 2?
So if I give that example again, the lower tier 1 is calculated using the lower earning limit. In 2013, the lower earning limit was 6,000 shillings. So 6% of that is 360 employee, 360 employer.
Okay.
That is called tier 1.
In 2013, when this law was actually being passed,
Yes.
it was saying 360 employee, 360 employer.
Yes.
Tier 1.
Yes.
Uh-huh.
That we must take to NSSF.
That must go to NSSF.
Yes.
Okay.
So what that means, it's an increase of 160 shillings on top
From
of
the current 200.
From the current 200 shillings.
Okay.
And then now they are saying the 6% will not be based on your on your current salary. It will be based on another limit, so that if you're earning 100,000, the 6% is not entirely on the 100,000. It is a section of that 100,000. So they introduced something called upper earning limit. So the upper earning limit on the first year is 50% of the national average salary. So 50% in 2013, the national average was 36,000. So the 50% of that is 18,000. So that is what, for the first year of implementation, 18,000 is the upper earning limit. So I come to the 18,000 again, I calculate 6%. That becomes 1080. Employee and employer 1080. Remember, you already did a 6% also on tier 1.
Yes.
On tier 1. Yes. So you reduce 1080 to the 360. You remain with 720.
Yes.
So this 720 is what will be called tier 2.
Okay. And this tier 2 can either go to NSSF
Yes.
or to your
A private pension scheme. Yes.
It's your choice.
It is your choice.
Your choice and your employer.
Yes.
Okay.
And this scheme is supposed to work in Kenya.
Yes, it is supposed to work in Kenya.
Okay.
When?
It is immediate from this month's payroll. When you get your deductions from this month, you expect that to be less by the amount that is being introduced to your payslip.
What's the percentage of Kenyans who are in permanent or what you call full-time jobs?
Well, okay. I can confirm that, and even that is a very valid question, because even out of all that big number that is in full-time jobs, only 20% have been saving for retirement. So
the number isn't that big. It was small and it dropped even further with COVID.
Yes.
Because if you look at the reports in the papers, in 2022, we're talking about 10 to 9% of Kenyans in full-time jobs. Many, the bulk of our population is in the rural areas, which means they are subsistence farmers. Now, with the vagaries of drought and the social systems that we have, where bread earners support very large families or very large numbers of people, a scheme like this becomes more of a fairy tale than a reality that can be achieved. Because if you look at whatever people earn and what the demands on that money is, unless that saving is forced, meaning by the time you are being paid, it has already been taken. Do you really think that this is a scheme that is attainable? That people can actually save, given what they earn and given the obligations that they have? Is it really, whether it is school fees, whether it is medical services? In countries where these things are possible, these things are taken care of. As a citizen, you do not have to worry about it at all. Children will go to school, medical services will be provided. So the culture of saving is something you can actually entertain. But in this country, given our country, our population, our situation, how tenable is it?
Fortunately or unfortunately, one of the requirements in the law is that if you have more than one employee, so whether it is a house girl or a houseboy, you must be able to register for NSSF, and you must ensure that those monthly deductions go there.
If you have more than one employee.
More than one employee. So every month you must, whether it's a shamba boy, is a house girl, you must ensure that you remit their contributions to NSSF. What they have introduced is that for people who are in private sector, there is something called a private voluntary savings. So you do not have to do the 6%, just do the 500 shillings per month. The challenge is you are even going very far in terms of sufficiency, in terms of comparing with the needs that members have, the populace have, compared to what we are supposed to save. If you do even the calculations yourself, even somebody who is earning 30,000 or let's say even 50,000, in year 5, the substantial amount of that will be going into retirement. So let's give an example of somebody in year 3 when the pensionable salary will be 36,000 times 3, that will be 108,000. When it is 108, the person earning 50,000, you'll calculate 6% of that. So that is 3,000 employee and 3,000 employer. That 3,000, if you keep going that way, at some point there come a time where this member is even saving almost 5,000 shillings to NSSF. So you look at it, leave alone the people in the village who are really struggling to make ends meet. Even there is a time that these people in turn will also have a problem in terms of how much they can be able to really push in terms of deductions from their payslip. But there are also so many ways to look at it. One of them is that saving is a good thing. We have to be forced, and you realize if I said today I'm paying you 100,000 Kenyan shillings.
Why must it be forced? You said it has to be forced. Why?
The reason why it's a culture issue. We are if I gave you 100,000 shillings right now, I tell you as from today, Charles, when I give you 100,000 Kenyan shillings, I'll pay you the gross figure into your account. Now you take out pay NSSF, pay NHIF, pay your loans obligations and all that. Most of us will be arrested, will be in cells every single day. Why this is being done is that you are it is helping yourself against yourself at some point.
So we essentially, adults in this country are being treated as children who cannot manage their affairs, and you need someone to superintend.
But Siti, you are the one who had actually even gone ahead with this one and said, unless you force people. Do you see this thing working?
I got it. I am now looking at this forced saving, and I am looking at, let's take a reality check. One of the biggest employers in this country are the public universities. Okay? One of the problems that they have had for the longest time is, making sure that those statutory deductions are deducted from the employees, but it is not remitted.
Correct.
Okay? Meaning they deduct it, but they use it for whatever else. Meaning these are government institutions that already have a problem with simply managing their affairs because of the money. Government.
Yeah.
Okay? Now, I am simply trying to extrapolate this and look at it and looking at the individuals. That's why I premised my discussion on the number of people.
Okay.
The saving culture is necessary. It is a good thing. It is a wonderful thing. Some of these countries we talk of who are able to do the things they do have a serious saving culture. But what is it that makes that saving culture possible? Because right now, even people and communities where people had a saving culture, it's become impossible to save, even if you want to.
I think you are very right. The challenges we have, of course, one is the earning the how do I want to call it, the earning power of an individual, and how much are they able? Should they put food first on the table, or should they put money to NSSF for saving for retirement? That becomes a hard question to deal with. But I think there are things also that we need to have entrenched in our curriculum. I normally think so. When I get to 30, when I'm getting my first job, that is when somebody just appears from nowhere and tells me, oh, Davis, you need to have started saving, you need to do this, you need to do that. I wish somebody came when I was 10, 15 years and tell me, Davis, before you earn money, you need to start saving. There are these ways you can be able to save money. Yeah. That is why we have people now think that you can have rich, rich solutions for especially for the young people. So I think much as the challenges regarding the economy and the power of people earning enough so as to save enough, there are issues also that include culture, include our education, that needs to be integrated so that it's a 360 degree, that when you are talking about saving, somebody really appreciates. I do not have money today, but if I get money, I will put money here. So we need to put that, handle it from the other side, because you realize the way you are putting it, you enforce it on people. So there are so many people who don't even understand this NSSF. They actually think it's another tax you are taking from them to do other things again.
That you are deducting.
Most of them don't know that this is actually a saving for them. So there is a lot of discussion that needs
Every
to go around.
deduction in this country is a tax.
Is a tax. Until somebody was saying that now I think what we do, let us give government all the money, let them return to us what they want, because almost everything we are paying is almost getting to tax. Yeah.
Let's take a break. 26 minutes to 9. Our guest is Davis Njoroge. Davis is a financial services expert. He's a general manager for marketing at a company called Octagon Africa. We are talking about the new NSSF rates, what they mean for employers, what they mean for employees. What is this new scheme? It's basically just getting to understand. Yes, there's a law that was passed in 2013. It's been up and down the courts for a long time. The courts have now cleared the way. The deductions are beginning end of this month. What's that? What does it mean for you?
Today, of the retirees who had saved for the last however many years that they needed to, do we see regular payment of their dues, apart from the lump sum idea? Are we seeing that they are paid and without any problem?
I think, Nduiza, it's good to acknowledge that there are challenges in this industry, especially there are arguments that when retirees go to NSSF, they'll have challenges. They have had challenges accessing their benefits. But remember, there is a law.
Sorry. What does that mean, that they have challenges? You go to the office, you wait for your account to be credited at the end of a 30-day period, as should be. You go for the lump sum, you don't get it. When you say challenges, what does that mean?
I mean, nowadays, I don't know whether all of us must be doing mobile banking. If you ask me, the banks have trusted to put money. You can be able to access money from your phone. But we in the pensions industry, you find that still it is paperwork. You have to go line up and sign some paperwork and all that, which if you asked me, it should be a thing of the past. You should be able to dial star something hash. And click access retirement benefits.
For January 2023.
Yes. And then when you access, you first should be able to see a statement.
Yes.
And then you should also be able to give instructions through the USSD that please pay my money to a certain account. But you will find that I think the bureaucracy around government institutions, you will be called, you must be able to come to the office, you must be able to sign this, you need to do all this. We need to get to a point where we revolutionize the retirement benefits industry. Everything must be done online. So to the point that you are calling a retiree from the village, you can tell them, no, just get somebody where there is a cyber, or get somebody who is technological savvy. They help you in applying these benefits, even if it's through your phone or even using an app. So that if you tell Amze to travel all the way, there are areas of Kenya where you will say the NSSF branch is a bit very far.
Yep.
You don't need to punish people to travel all the way for that. So there are those type of challenges, but there is a law that you must, whether it is a private pension scheme or it's NSSF, when a member applies for benefits, you must be able to pay them within 30 days.
Davis, are people being paid within 30 days? Or are those the challenges that you're talking about? Is it actually happening? There's a reason I'm asking this question, because I'm going somewhere with it.
Yes.
Is it happening today with the 200 shillings that you are paying and the 200 shillings that your employer is paying? Those who retired, are they going at the end of every month? Are they receiving their money?
I think. Okay, I do not have exact figures, but I know
ballpark generally.
But I know we have in terms of streamlining. NSSF have also tried to streamline quite a number of things when it comes to. I don't want to speak on their behalf. I don't work with them. I don't work for them, but they have also tried to streamline. There are a few things which you can be able to access online, but I think if they are still do manual processes, I think it's just our time to encourage them also to see what they can do to streamline the processes.
All right. So, because we've come from this premise of people need to be encouraged to save. People need to be encouraged to save for a rainy day. All of this when you retire, to be able to maintain your lifestyle. Now, there's a challenge with the 400 shillings. Now we are saying multiply that by 10.
Mm-hmm.
Those who are receiving the 400 shillings calculated on whatever and now are pensioners, there's a challenge. Can you see how it would discourage people now if we're saying now multiply that by 10 and then bring out more money for a system that has challenges? Do you understand where I'm coming from now?
I understand where you're coming from, but that also the good news. I was actually thinking at some point NSSF will also have to be. They will get a lot of competition from private schemes. Remember, you find the tier 1 is only what is mandatory to go to NSSF.
Yeah.
The tier 2, which is the larger
majority.
amount,
Yes.
will be going to private schemes.
Right.
So even in a private scheme, do you come and I pay you within 5 working days? NSSF at some point they will have to get into the pressure that look here, when my money in the other scheme I've been able to access in five
Working days, and you're
5
telling
working
me-
days. What are you telling me?
Sure.
So I think they'll have to be pushed at some point, and market will also have to push them to some point. But everything will be solved when right now if you go to the bank, I don't want to mention the bank I use, but there's a point when you go to the branch, there's a point where you'll come and find no one in the branch. Reason because you can be able to do everything by a click of a button.
You don't even need to go.
You don't even need to go. When is
Yeah.
the last time you went to a bank branch to withdraw money? You can be able to go and access that. Even a check deposit you can do through the ATM. What makes pension schemes very different? You know, I've been working with an employer. They know me all that long. Why do you also want me again to come to your office?
Yeah.
Why don't you? My employer has written a letter. They can even forward to you an email so that then you process for me the benefits. So that it's all about the processes and the streamlining. Once we do that, it becomes a bit easier even to manage relationships with people who are retiring and who want to access their money. Yes. If you dependent on manual processes,
Kitaumana.
kitaumana.
Should NSSF first have been revamped before you tell people to contribute more? Because if the pushback that you get from very many people is,
It's a mess already.
this pot, I've been contributing for X number of years into
Yes.
this pot, I'm not even sure. From what I hear, those who qualify for retirement benefit, they are not getting the services they should be getting. And now we are going to put more money into this thing. Should they have, first of all, or maybe work concurrently with cleaning their image and their public perception, and then say, see, we're doing the best we can now, bring in so that we can even do better.
I think in all fairness, Eric, there have been a bit of improvements in NSSF. There are so many things that used to happen 100 years in quotes ago.
NSSF is
not
58 years. Now, tell me what these things are so that I can understand. These improvements that you speak of, what are they?
They have been working around governance. One of the major issues that members have been complaining a lot is also in the return. When I give you my money and you give me a return of 5%, I'm supposed to ask you what the hell have you been doing with my money? Inflation is at 9%. You have given me a return of 5%. Why did I give you my money in the first case? Yes. I'm subsidizing inflation. Why did I give you my money? Normally, if it's in private organizations, you need some caning because I gave you my money, you came back with a loss. So and the challenge they used to have is some investments which they normally never used to do properly initially. But now I am happy. I think at least even when you look at the latest report, I was looking at the reports that are done by Financial Regulatory Sector report. The 80% of their assets are now being managed by outside fund managers who are regulated and who are licensed by the regulators to be able to provide that service compared to you doing that internally.
So there are third parties doing
Yes.
roles.
Yes. And last year, I think, is it last year or this year? I saw when the Auditor General gave a report, I think they were highlighted in them some challenges that are still with NSSF. But one thing that was a bit giving us hope is that the return at least was close, I think, to 7 or 10%, if I'm not wrong. So there have been improvements, but I wish it will get to a point where even the investment, even the 20% they have remaining with in terms of investment, it is invested by an expert, so that when it comes to asking us hard questions, for example, how do I access my benefits, but am I also, whatever the little amount am I giving you, are you investing it prudently to ensure that I'm getting a market comparable return? Everyone in the market for the last 5 years has been giving 10% on average. Why are you giving me less?
Less.
Yes.
But you see, the people who should be asking these questions start with the board. The board comprises various interest groups. We know this. So the board comprises the employers are in the board of NSSF.
union.
The union, that's the employees, are in the
Government.
board of NSSF. The government is here. So you'd expect that at least the whole idea of having these people sitting on the board is to represent the various interests. So those questions of, our members, our union members have been contributing and they're not getting the benefit should be something. Our members, employers have been contributing and their employees are still suffering should be answered.
I think I'll just repeat that in all fairness, I think they have really done a lot of improvement.
They need to communicate better, right?
I think probably they are doing very many good things, but we might not be knowing. So if you look at it, we only know of the bad side.
We only remember
Sometimes
of
also
the scandals of 15 years ago.
But these things are not what you call bad things. I mean, if it's reported that it happened, it happened. It's not as though one is going out of their way to give NSSF a bad name. If your function is to ensure that people save with you so that in retirement they can get their money, and they retire and they're not able to access that money, how is that a bad thing? It's bad for the person who's expecting their money. But for NSSF, if that's what is happening, then they apart from explaining it, because
fix it.
you're not talking about money that is to be given. It is money that has been given. So why should those who expect the money not get their money in a timely fashion? If you're telling me that right now, people who retired last year are getting their money today, or they've been told you get it after every so often and they get it regularly, then then you would say it is working. Is that the case?
I think I do not have a single case where somebody has completely not been able to access their money.
No,
I
that's
think,
not what I asked.
I'm getting there. I think the challenge that you have is how quick do they get that money?
Yeah.
And I think I said it that the best way to address it is that to encourage them to ensure that they make use of technology.
Okay.
We need to get to that point. They do not have that option, so that then they can also be able to compete with other market players when it comes to quick accessibility of funds and convenience for those people who are retiring.
Let's talk about operations of NSSF just for a moment. So maybe it would give rise to some of the understanding of what actually is going on. Because the question is, if I have put money in regularly for the last however many years, the assumption is that the money is sitting pretty somewhere, and that when I come to receive it on a monthly, the way I paid on a monthly, logic only provides that I would get it, right? Now, perhaps something else happens. After all, it is a fund. What happens, from your knowledge, of the money that is contributed on a monthly basis? What does NSSF do with this money that perhaps could explain the reasons why, when you come to get it on a regular, it's not readily available? They have to maybe do some internal processes, remove from here, liquidate. What happens with the money that you contribute to NSSF?
Normally, like any retirement benefit scheme, every time that you contribute money to a retirement scheme, the money is invested, does not sit in a bank. The money is invested, they'll go buy equity, they'll buy government bonds, they'll go buy treasury, everything. But there is something that is done. The fund managers do something called asset liability matching. What that means is that they are able to foresee, these are the number of retirees that we expect in the next 5 months, in the next 3 months. So that then you put money in what we call cash and near cash. So that when people who are retiring, they want that money, you do not have to go and sell a bond. Or just start looking for buyers for property for NSSF. You go and liquidate the things that are cash and near cash, so that you can be able to meet your liabilities.
Okay.
That has always to be a prudent fund manager has to always ensure that we always have funds, and you can always see from reports that this quarter
We have
is the
X
amount
number of
X
people
amount of,
who are to
yes,
be
yes,
paid.
Yes,
isn't
yes,
it?
yes. So,
Huh?
and I think, and NSSF has access to the data, including our dates of birth and all that.
One
so
would hope.
Yeah.
Yes.
So you will imagine they can be able to even imagine this the number of people will be tying this, so you can be able even to calculate and know how much money you'll be able to pay them. So where there will be challenges, and I don't think really it's only NSSF alone, it's that if we do not do proper asset liability matching, then when there are two things: either you are ineffective to the point that when I bring papers on your desk, you sit on them, or you actually don't have the money. If you sit on the papers, then that becomes an issue. Or if it's an issue of asset liability matching, I think that is also a failure on your side. You should have been able to foresee early enough to how much money you need and all that.
But isn't that what we are saying, Dave? It's that the inefficiencies are not challenges. It's not as though I'm trying to get from point A to point B in the car and then I find traffic on the road. That's not the kind of challenge that we're talking about. You are aware of the portfolio. You know the number of people who have contributed. Just like you say, you have the records, isn't it? You know, okay, in the month of January 2023, according to what the portfolio is, we know that X number of people are supposed to be getting X number of. You know this in advance of time.
Correct.
So I choose the suggestion that you've given, that number one, you're either ineffective, or number two, you don't have the money properly, and you didn't plan properly.
Liquidity.
Now, this is the question leading to, coming from what Eric was asking, is that how then, taking these things into consideration, this is what is currently happening. This is not a futuristic thing. It is currently happening. Now we are telling Kenyans, you know what? In this same fund,
Put some more money.
put some more money. And hope and pray that by the time you retire, things will be better. How?
You know, this discussion we're having here, we are having the discussion because NSSF is directly comparable to a problem that never seems to come to an end. If NSSF was doing all these things that you're saying they ought to do, would we even have this discussion? People would be eager to put in money because they know that they would get the return. There would be no problem. And given the history they have, 58 years, the reputation would be this institution gives you your money when you need it and as you agreed with them. So the problem wouldn't be there. In fact, the opportunity to put in more money would be welcomed. But we're having this discussion because that is not the case.
I normally think there are areas of even benchmarking. If you look at the NSSF Uganda, we do a lot of benchmarking with NSSF Uganda. And whereas in Kenya, we are even struggling with the 6%. Where are we taking to NSSF in the first case and all that? NSSF Uganda, the percentage is even higher. I think I forgot to pick the exact percentage
of contributions
for Uganda. For NSSF Tanzania, it is even almost 20% in terms of what goes every month to NSSF. Every employee and employer must be able to take that money to NSSF. So when you compare it with the East African region, we are still on the lower end. But I think it's good feedback that we are giving, that we have challenges. One is when we hear that our relatives, when they come to accessing money, they take a bit longer. But secondly, also, the feedback we are giving them, and we encourage them. I don't think really we are criticizing them. We are giving them feedback and telling them that when it comes also to return, please try to check how you can be able to optimize returns so that, remember, what you will be accessing in retirement is based on the contributions that you actually make plus the income. So the more the income, the better, so that to help these retirees also live comfortable. We have seen in the last 2-3 years, and for all retirement benefit scheme, the property portfolio has not been giving proper return. So if a scheme, and I'm not saying any of the scheme, notably, decides to go and invest in property right now, then they are going to dump members' money and all that. So we must be able to do prudent investments to help our members give a proper return. Otherwise, we will be forcing people to contribute, yet we are not giving them a good return. So at the end of the time, they only have a bare minimum, which beats the sense why we first have that discussion on investment. So I think, for me, I do not think there is a bigger challenge in accessing of benefits from NSSF. The major challenge is actually on them improving on the current return so that by the time the members access, they really get a good return.
The president has been very big on this issue of NSSF. And one of the things that he has said is, well, even for government, they'd like that people contribute into this scheme, because then the government can also come and borrow internally from the retirement benefit scheme. What do you think of that? Because there are now people who look at it and say, Ruto nataka tuweke pesa hapo ndio ende akachukue pesa hapo.
It's not a bad thing to actually, for schemes it is a good thing to give government money. The reason it's a good thing to give government money is that government, if there are asset classes. When you look at the guidelines provided by the Retirement Benefits Authority, there are guidelines. You can invest your money up to 70% in equity, 90% in government bonds and papers, and then you can do up to 30% in property, 5% in all that. When you give government money, like now they have been giving money at 14%, they are borrowing money at 14% for an infrastructure bond. Mark you, that infrastructure bond, when you borrow at 14%, it is tax-free. So for a scheme, it's actually a good thing since it's an investment where you can actually get 14% return. Comparing to where the market rates are and where the infrastructure is and the interest rates, it is a good thing. But I also want to think this way, that it is also good that we increase how much money that goes into retirement benefit scheme, for the simple reason is that when you go to these other developed countries, they are not going out to borrow money from other countries to be able to do infrastructure development in their local countries. They use money that is available in the retirement benefits pots, so that they can borrow from there locally and do infrastructure. You look at it, for example, the expressway that we always talk about. If you look at the cost and you look at how much money we have in retirement benefit scheme, currently retirement benefit scheme have almost 1.5 trillion of assets. 30% of that can be able to be invested in property. So if you look at that, is almost 400 billion. If you I think the expressway, the figure could have been almost around there. If at some point early that enough we were able to foresee all that, we don't have to go borrow expensive money, and which is dollar denominated. We can borrow locally and then but provide a structure in a way that these benefits for members are guaranteed. Mostly what government do is they do not borrow the actual money. They will use maybe through a bond, so that then you subscribe into the bond, and then that bond is used for infrastructure. So it is a good thing that money is able to circulate and grow our economy. The Mau Summit Road that we are talking about.
Thank you. Thank you for joining us. 1 hour is good enough. It's short enough time, but we'll invite you again. Davis Ngiro, a financial services expert,
is able to circulate and grow